Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Thank you all for tuning in. Today I want to speak about home ownership specifically for Gen Zers and the things that you should consider before either choosing to continue to rent or purchase a property for the first time. The American dream, home ownership, has always been seen for generations in this country as kind of like something to look forward to because it provides a lot of benefits in the long term, including building equity in your home, which we'll talk about. It's a way of passing wealth down to other generations as well. So it could be a great benefit to be a homeowner. But I wanted to talk to you about some of the things that you should consider between looking at homeownership versus renting and some of the benefits on both sides, some of the downsides on both sides, because it's not really a straight answer. A lot of people can do very well by purchasing a home, and some people are actually better off continuing to rent as a result. And I'll give you some examples as we go along. So let's consider some of the long-term benefits. When you look at buying a home, one of the major benefits is that over time, you tend to build equity. Now, what equity is the difference between the value of the property and the balance on your mortgage. So for example, if you bought a home for $300,000 and you put 20% down, which is $60,000, you borrowed $240,000, 80%, right? That means you have that $60,000 of equity because $300,000 value minus the $240,000 mortgage creates that $60,000, which is the initial down payment. Now, the great thing about real estate is that over time, it tends to increase in value, right? So let's say 5 years go by and now your home went from $300,000 to $350,000. Well, now you have the initial $60,000 in equity that you had, that you put down yourself, plus the additional $50,000 that it grew in equity. So now you have $110,000, right, in equity. And this is one of the major benefits of homeownership because then you can do something with that equity. Let's say you choose to either do a cash out refinance where you can borrow a new loan and take cash out to tap into some of that equity. Or you can keep your existing mortgage and apply for a home equity line of credit or a home equity loan and tap into some of that money. There are limitations set by the banks, but normally you're able to tap into some amount of that equity up until certain limits that banks put on you. But, let's say you had $110,000 in equity, you might be able to get $80,000 or $90,000 out, depending on how you structure the loans. And that can be used as an opportunity to then use that money to fund other things, whether it's paying for college or doing further home improvements. Some people use that if they want to build like their own real estate portfolio. They use the equity in one home to then take that money and put it towards the down payment and closing costs on another home. So over time, you can build this equity that you can potentially tap into and then use for other things. So that's one of the major benefits. Now, what are some of the downsides of home ownership? It's the fact that it typically requires a much larger initial investment than renting would. When you compare down payments and the initial closing costs to what you would require to rent, it's usually a huge difference. So going back to the $300,000 home, for example, if you need to put 20% down on this home, is $60,000 plus closing costs on top of that. You have to pay certain things at closing, some of them up front, like homeowners insurance and things like that. Now, you do not need to necessarily put 20% down. There are programs available that let you put as little as 3 or 3.5% down. For example, the Federal Housing Administration program, the FHA, you can put less than 20% down. Now, that comes with some of downsides of its own. Ideally, the bank would want you to put 20% down, but there are options for you to not have to put 20% down. But then it increases your cost over time because your mortgage payment overall is going to be higher. The reason for that is because If you don't put the 20% down, then you have to pay what's called PMI, which stands for private mortgage insurance. The lender will require you to purchase this additional insurance in order to protect them if you ever defaulted on the loan. So now you have your principal and interest, which is your mortgage payment that you have, your property taxes, your homeowner's insurance, and then on top of that, you have an additional expense called PMI. And that can range anywhere between 0.5% to about 1.85%, depending on certain factors. But that can add a couple of $100 extra to your monthly mortgage payment for a very long time. There are ways of getting rid of PMI. So traditionally, if you stay with the same loan, for the most part, once the value of your house increases or you're paying down the mortgage or both to the point where the house is worth a lot more than it was, but usually 78 or 80%, the loan balance has to be what they call the loan to value. So if your mortgage balance is 80% of your original purchase price, the bank will typically automatically just get rid of your PMI. Now, you don't have to wait that long. Let's say interest rates change, and when you first purchased the house, you had a higher rate, your value went up, and you have the opportunity to refinance that mortgage. If you borrow on the new loan 80% or less of the balance, you can also get rid of the PMI as well. Now, with the FHA mortgage, you're stuck with it. If you put less than 10% down as of now with current guidelines, then you're stuck with PMI for a period of 11 years, right? So that's something to consider when you buy a home, if you're going to put less than 20% down, because you have this PMI factor that now is going to raise your payment even further as compared to renting. You know, when you look at renting, the amount of money that it requires to get into a rental property is very little compared to the amount of money you would need to buy a home. At most, you probably need, usually standard is 1 month security deposit and 1 month's rent, right? So if your rent's $1,500, you only need $3,000 to get into this apartment. The other thing to consider too is when you think about buying versus renting, if you own your home, you have now transferred all of the responsibility for maintenance, upkeep, and so on to yourself. And then you have to decide, am I going to be the do-it-yourselfer kind? Because if so, it's going to require a lot of hours and stress on your end, unless you just are naturally handy. I know I'm not. So whenever I have anything that goes on, whether it's a clogged sink or anything, I just pay somebody, right? But you have to decide, am I going to then spend hours looking at YouTube videos, trying to figure out how to fix these things, how to do all these projects? You know, every homeowner I know has never-ending projects. No, even if they bought a beautiful home, there's always something else that they need to change to make it more just palatable to their lifestyle. There's always a project. So you got to think about that. How am I going to pay for these things? Am I going to just do it myself and just spend countless hours and stressing and making mistakes? Or am I going to go I'm just going to pay somebody else to handle this for me? And if you are, then you have to consider how much money is that going to cost based on projects and even things that are unforeseen. You know, things happen on homes, like your heating and ventilation system might go out, and that could be several $1,000s. Whereas when you're renting, you have to have peace of mind of, okay, I live here, but aside from paying my rent, anything else like a clock saying refrigerator stops working, etc., I can just call either the maintenance or the property owner. So that's something to consider because it's also a part of your lifestyle. So when I was telling you before that a lot of people can do well renting versus owning, it depends on not only your time, effort, and stress levels, but also some of the finances. So to give you an example, let's say that if you were to buy a home, you'll be leaving yourself cash strapped where you're no longer able to do anything else, including saving, like on your 401k or building up your cash reserves. Then probably buying a home is not the best thing, even though, yes, you're going to get equity. But if you're doing it at the expense of being cash strapped and then something happened and you don't have enough emergency savings, it's probably not the best choice. All right, so let me give you an example. Going back to that $300,000 house. Let's say you buy a house for $300,000 and the house appreciates at 2% every year on average. And let's say 7 years later, the house will be worth about $344,000. That means that you have an additional $44,000 in appreciation there as part of your equity. Now, let's say that the difference between your monthly mortgage payment and your rent is $1,000 before you buy that property. And you say, okay, instead of me getting into this mortgage, I'm actually going to invest this $1,000 a month, say in your 401k or wherever, for the next 7 years, and say you average 7%. Well, that will have $108,000 over 7 years. 84,000 of that was your own money, right? 1,000 a month to 84 months. So that means your money grew by $24,000 as compared to $44,000 on the house. So when you first look at it that way, the house gave you an additional $20,000 in equity. But if it meant that you couldn't save, what if the heating, ventilation, air conditioning, the boiler, something broke, your roof started leaking, right? We're not considering that over that 7-year period, which probably eat away at that $20,000. So it's something to consider. Also, if another emergency happened non-related to your house and you were strapped for cash, you can't tap into your home equity unless you either get a home equity loan or you refinance or you sell the home. Whereas the money that you were saving, let's say you were saving it in a brokerage account or a Roth IRA or something like that, some of it, you have access to it during that time. So there's a lot of factors to consider, your liquidity, the ability to save every month. What if a major event happens? How are you going to cover it? Being a homeowner is not necessarily the best option all the time. A lot of people sometimes feel like when they're renting that they're throwing money away, but that is not necessarily the case. Either way, you need a place to live. So you're not throwing money away by renting. It depends on what you do with the difference between what your mortgage payment would be and your rent, and also the initial deposit, right? Because if, let's say you did have enough to put 20% down, in this case, with a $300,000 house, you're giving up $60,000 up front. You might recoup some of that, obviously, when you sell, but in the meantime, it's trapped in the equity in the house. And that's something that you could have done something else with. So in the calculation that I showed you earlier, I didn't even include how much money that down payment would have made had you not bought the home and also invested and then add the additional 1,000 for those 7 years, right? So in order to give like a orange to oranges comparison. So I didn't include that there. So think about it from that perspective. Also, when it comes to financing, there are several different ways that you can go about it. Traditionally, most people get a 30-year mortgage. That's probably the most common loan. There are also 15-year mortgages. There are 20-year mortgages. I did a podcast episode on that. Definitely check that out because it's a little known mortgage. Usually when you go to the lender's websites, they only show you the 15 and the 30 for some reason. But there is a 20-year option, which is probably the best of both worlds because your mortgage payment difference between a 30-year and a 15-year is huge, but not as much in a 20-year. And you're able to pay the house off 10 years sooner, right? So something to consider. I would say if you are going to go buying, make sure you ask for a 15-year, 30-year, and a 20-year rate and payment just so that you can compare. Another thing to consider when you're buying a home, do not go by what you qualify for. Because initially, when you go either online and get pre-approved, you're going to get a number based on how much money you earn gross before taxes on the expenses. And also, they're going to take into account only the minimum payments on the things that show up on your credit report, like your student loans, car payments, and credit cards. They don't take into account anything else like utilities or anything like that that isn't something that will show up in your credit report. So when you get pre-approved, you might still get pre-approved for a higher amount than you can actually afford. So that's something to keep in mind as well. I'm always very conscious of that. So what I do with my clients is, aside from making sure that they qualify for the home, is making sure that they could afford the home. And a lot of the times, the number that they qualify for tends to be bigger than what they can pay in reality. So what I do is there's a way you can back into the payment, which is great if you're working with a financial planner because they can help you determine how much can you actually afford. What we do is we take the overall monthly payment, we subtract the property taxes and the insurance and anything like that. And then if you tell me, okay, I can afford $2,000 a month and the property taxes and insurance are $500, I subtract that from the $2,000 and see what a $1,500 mortgage payment would be. and then back into it that way and say, okay, $1,500 mortgage payment at X interest rate for 30 years is this amount, and that way the most you should borrow in order to stay somewhere within the payment that you desire, right? Because the last thing you want to do is like force yourself into a higher mortgage payment and say, oh, we'll figure it out once we're there. Is the wrong way of going about it, because it's going to be quite a significant increase to your lifestyle, and you want to make sure that you're prepared before you do that. So don't necessarily be so pressured into thinking that you have to purchase something, because a lot of the times too, buying something in an area that's super desirable to you may not be realistic, whereas you might be able to afford to rent something where you want to live and still be able to save money and invest every month and put money in your 401k and open up a Roth, right? There's nothing wrong with that either. So you can do very well either way. So it's not that straightforward and say, okay, buying is better than renting or vice versa. Lifestyle takes a big role in it, and also your overall finances. What else can you do with the money you would have sent to the mortgage, and so on, right? So sometimes it's completely fine to rent. Now, keep in mind that not all rentals are apartments, right? So I've rented homes before, and I too have responsibilities similar to a homeowner. Even though I was renting, I've had a house before where I was, as the tenant, responsible for the monthly upkeep outside. Like I had to pay for the landscaping. I was also responsible for the garbage pickup, and I was also responsible for the water bill. And these are all things that are stated in your lease. So you want to make sure that you take that into account as well, because I kind of felt like I was the homeowner, but I wasn't getting any of the benefits. Another thing too is a lot of people can benefit when they buy a home from a tax perspective. So you also want to consider the tax equivalency, because what happens is when you file your taxes, when it comes to deductions, you can either itemize your deductions, and I'll tell you what that is in a second, or you can take the standard deduction. The government gives you the ability to take the standard deduction, no questions asked, right? So let's say a married couple filing jointly, there's $25,900 that they can deduct from their gross income in order to arrive at their taxable income. So if they made $100,000, $75,000 will be taxable, right? If they take the standard deduction. You can also take the bigger number, which is mortgage interest, state and local tax, which includes property taxes. Right now, that's capped at $10,000 per year. So between state and local tax, if you can only deduct $10,000. If you have mortgage interest on top of that $10,000, and let's say you also have other deductions like charitable distributions and so on, you can then possibly itemize if the numbers together exceed what the standard deduction is. So that's something else to consider, because I know of people that have bought homes thinking they will get a tax benefit off of it, and then later on realizing that they were still going to take the standard deduction anyway, because the standard deduction was much higher than the amount that they were paying back in property taxes and mortgage interest. So that's another thing you want to really look into. Speak to your financial planner or your CPA about. Make sure that if you are buying it and you are going to have a tax benefit, and you want to take that into account, that you know that ahead of time, and not thinking automatically that because you bought a property that all of a sudden your tax situation is going to improve significantly, because it's not necessarily the case. There's a great possibility, especially since the Tax Cuts and Jobs Act pretty much doubled the standard deduction. A lot of people that are homeowners are not really able to get any tax advantages on a year-to-year basis from owning that home. There's benefits down the line. So, for example, going back to equity, if you're a couple married, filing jointly, and you live in the property 2 out of the past 5 years, you can have up to $500,000 profit from that primary residence, tax-free. So that is a major benefit. But I wanted to bring out the yearly 2-year benefit, because some people think, oh, I bought a home, now my taxes are going to be a lot better when I file. Not necessarily the case. But these are all the things that you definitely want to sit down with a certified financial planner about, certified financial planner professional. You can go to letsmakeaplan.org, which I'll put a link to in the show notes. I'm also going to put a link to the article that I just wrote about this very same topic in case you want to read it and go a little deeper into it. But be sure that you sit down with a certified financial planner professional that's going to take a look at all these things, ask you all these questions about your lifestyle, the money that you can save and or invest, the initial money that you have available, so that you can make a proper decision before you decide to just jump in and buy something, because maybe renting might be better for you, right? At least for now, it might make more sense to buy something down the line. But you want to make that conscious decision without just jumping into something, right? So thank you all for tuning in. Stay tuned for more episodes to come. I have some great interviews coming up for the rest of the year and the next weeks to come. So I appreciate you. If you have any questions, as always, send me an email, luis@onmywaytowealth.com, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.